At the Central Financial Work Conference held in the waning days of October, the iron fist of the judiciary is coming down hard on the financial sector's leaders, with the recent arrest of Zhang Hongli, the president of the Industrial and Commercial Bank, and a number of other bank presidents. Below them are the prosecutorial and judicial branches, above them the National Security Commission, together tightly clutching the reins of China's financial system. Moreover, the outreach of the Central Commission for Discipline Inspection has extended to the Foreign Affairs Department, such as the downfall of the former Foreign Minister Qin Gang. At the same time, Evergrande's real estate tycoon Xu Jiayin was arrested. Now, the medical system is also under the control of the judiciary officials. All sizable enterprises have been required to establish CCP committees, and state-owned and central enterprises have set up armed departments extending even to schools. Following Xi Jinping's consolidation of power post-20th Party Congress, a rapid formation of an all-encompassing autocratic structure has unfolded within a year, presenting a stark microcosm of China's macro control today. It symbolizes a thorough erosion of individual freedoms and is a silent alarm to the nation's drift towards extreme centralization. In the financial sector, a grim pattern has emerged. Arrests are made, assets are confiscated, and deficits are filled. The case of Zhang Yukun, president of the Shengjing Bank in Shen Yang, who was arrested for lending $100 million to Evergrande and demanding a kickback of $30 million, exemplifies the crisis. For lending $270 billion, a kickback of $81 billion was sought. Her arrest has led to asset confiscation and debt repayment. The case has galvanized Xi Jinping's resolve to rigorously investigate 2 decades of corruption within the financial circle. Loans involving local government bonds and urban investment bonds from financial institutions over the past 20 years, typically incurring kickbacks of around 8% and in severe cases even double digits, are under severe scrutiny, with the central government determined to trace back 2 decades to apprehend those involved in kickbacks. In the event that financial books still cannot be balanced, the Chinese Communist Party is prepared to resort to printing money and issuing central government bonds to allocate funds to local governments, enabling them to repay their debts to financial institutions. Since the beginning of this year up to October, nearly 8 trillion yuan in central financing bonds have been issued, with October alone seeing a record 1.4 trillion yuan. Under these circumstances, if financial institutions default, the government is poised to take action. This political intervention has left the financial sector in a state of self-preservation, fearful of arrests. Financial regulatory bodies are also bracing for a major purge to strengthen the oversight of financial institutions. The involvement of the Ministry of State Security in financial supervision suggests a tighter leash on high-level economic figures. In the past, if economic issues arose, economic divisions of local public security bureaus would step in to investigate, and due to their close ties with local industries, inquiries into business magnates were often lenient. This is often shown in investigations into entrepreneurs such as founder of Alibaba, Jack Ma, and former CEO of JD.com, Liu Qiangdong. Should the state security apparatus take a direct role, the situation could drastically change. Organized under the direct command of the Central National Security Commission, any central directive for investigation could render local connections and legal procedures ineffective. There is even speculation that high-profile entrepreneurs like Jack Ma could be among the first to come under close watch. In an article published on WeChat by the Ministry of State Security on November 2nd, it stated, "Certain ill-intentioned individuals aim to stir up trouble and exploit chaos for profit. There are not only those who bet on a market downturn by short selling, but also those who talk down and hollow out the market, trying to undermine the international community's confidence in investing in China with the aim of triggering financial instability in the country." In this vein, blogging that the stock market will decline, that the economy will falter, that financial strife is on the horizon, and that a debt explosion is imminent is referred to as talking down the market. Experts who suggest at conferences that the stock market might fall are deemed to be betting on a downturn. Securities analysts are only permitted to predict market surges. Any forecast of a downturn constitutes illegal activity that undermines China's economy and national security, leading to arrests. The ministry's actions have reportedly jolted capitalists into a state of alert. Previously, both domestic and international capital only voiced concerns over the opacity of China's stock market. Now, the situation seems to have escalated with claims that the Chinese Communist Party has introduced enforcers into the mix, prompting capitalists to plan their escape from the stock market. Moreover, the tone set by the latest Central Financial Work Conference has been made clear. The capital market is a financing function, and companies should continuously raise funds from it for investment, implying that selling stocks is not the favored action. The absence of assurance for investors to receive more returns from the stock market has allegedly heightened capital fears. Seizing the opportunity presented by the ministry's hardline stance, foreign capital has reportedly been fleeing en masse. With northbound funds, foreign capital invested in China's stock market through Hong Kong, withdrawn daily. Industry insiders predict that these funds might completely exit the market in November. On November 1st, the Vanguard Group, the world's largest mutual fund, sensing an unusual shift, timely withdrew from the Chinese market, foregoing a $4 trillion market opportunity. By November 4th, management consultancy company Gallup had pulled all its institutions and personnel out of China. The back-to-back withdrawal of two renowned foreign institutions within 3 days has led to a trust deficit in American political and business circles towards the Chinese Communist Party's narratives. The ministry's article also noted certain countries use finance as a geopolitical game, repeatedly exerting monetary hegemony and readily swinging the financial sanctions club. The U.S. sanctions against China are currently mainly in the realm of investment restrictions in high-tech sectors, without full-scale economic sanctions being imposed. The tone of the ministry's article suggests that the Chinese government might recognize the possibility of increased economic sanctions by the U.S., especially if China continues to take stances in international affairs opposite to those of the U.S., such as support for Israel or Iran, or escalate the situation with Taiwan. Regarding the stern warnings against the behaviors of talking down, betting on a downturn, short selling, and hollowing out the market, commentators overseas have noted that the ministry might indeed be preparing for arrests. Media in Hong Kong, such as the South China Morning Post and other financial news outlets, might face detentions if they continue to talk down the market. This threat could extend to media in Taiwan and Singapore as well, along with foreign independent media criticizing China's economy, who may also be subjected to threats by the Chinese Ministry of State Security. Experts from Wall Street and foreign journalists may find themselves denied visas to China. As for those who transfer funds overseas, like certain elite members of China's medical community recently scouting real estate in Australia in anticipation of a major withdrawal, these actions have not gone unnoticed. Although these professionals remain in China, having only sent their families abroad, they now appear on the ministry's blacklist, and their families overseas may face the threat of abduction, potentially coercing these experts to repatriate their funds to the mainland. The Ministry of State Security appears to be quietly casting a net to block any cross-border flight of capital, with the avenue of digital currencies now sealed. For substantial domestic capital, the prospect of escape through cryptocurrencies is now implausible, and even moderate sums face tough challenges, mostly restricted to fleeing via Hong Kong. In a couple of months, transferring money out of the country could be criminalized as endangering national security, leading to direct apprehension by the Chinese Communist Party. Though the ministry usually operates without public disclosure, the publication of the article suggests a hidden message when read between the lines. The article said, experiences of certain countries show that severe systemic financial risks and crises not only lead to long-term economic downturns, wiping out years of economic gains and social wealth, but also spill over as global risks affecting other nations. The subprime mortgage crisis and European debt crisis of this century triggered a global financial storm, plunging many countries into economic slowdowns, financial mistrust, societal imbalance, and widespread unemployment. This brings to mind the scenario of large-scale shorting of the Chinese yuan. As November begins, the yuan's exchange rate has plummeted markedly in against the British pound and the euro, but it has maintained a relative stability against the US dollar, which has also suffered significant losses. Despite current signs of easing tensions between China and the US, it remains to be seen if the yuan will undergo a steep decline against the dollar in the near term, or if it will face widespread short selling in the months ahead. If financial heavyweights indeed decide to short the yuan, China's central bank might resort to printing more money, using substantial amounts of local currency to buy dollars at elevated prices, thereby manipulating the exchange rate. In such a scenario, the Chinese Communist Party would be essentially issuing excess currency under the pretext of a national financial crisis. A devaluation of the currency could lead to profound impacts on the everyday lives of the populace. At the recent Central Financial Work Conference, the policy for affordable housing was put forward. The land cost for such housing is much lower than that for commercial residential buildings, with sale prices roughly equivalent to 1/5 to half of commercial housing prices. The government may also consider converting commercial housing units that have not been sold into affordable housing. Initially, developers had been expecting that those purchasing subsidized housing would help clear the inventory of commercial housing, improving liquidity. They also hoped that the bad loans issue caused by the real estate debt crisis would compel the government to remove pricing limits, allowing for discounted sales to alleviate financial difficulties. However, the government chose to intervene directly, providing subsidized housing to the urban unemployed or low-income groups to avoid social instability. With real estate debt potentially dragging down the banking system, the government showed no inclination to relax price limits to rescue developers, preferring to let the market naturally eliminate some private developers. Consequently, numerous non-state-owned real estate companies have started changing legal representatives in preparation for corporate restructuring, attempting to shift the legal responsibilities of management. Under this policy framework, the construction and development of subsidized housing will be mainly entrusted to state-owned enterprises. Although these projects may have limited profit, the assurance of sales and rapid capital recovery means state-owned real estate companies can maintain cash flow and survival. This strategy is likely to drive many private real estate companies out of the market, solidifying the position of state-owned enterprises in the industry. Citizens ineligible for subsidized housing may obtain housing at lower prices, but this benefit comes with certain restrictions, including constraints on the place of work and mobility. To maintain the nature of the housing security, buyers must sell the property back to the government when leaving their registered place of employment and cannot trade freely on the market. This not only restricts individual freedom, reducing labor mobility. If one cannot work in other cities, change jobs, start a business, or switch careers, what dreams are left to pursue? Labor is a factor of production, and when it is inactive, the vibrancy of the economy is also reduced. With the expansion of the subsidized housing policy, the importance and influence of housing construction departments have correspondingly increased. Previously, individuals relied on bank financing and developers for housing involving some degree of market competition. However, as the acquisition of housing shifts to the government's housing departments, this layer of market competition is eliminated, further reducing the freedom of choice for ordinary people. The recent Central Financial Work Conference has had a significant impact on China's operations and management. The key words are arresting and seizing assets to fill holes, with financial stability being maintained with the participation of the Ministry of State Security. The stock market, local government debt, and the real estate market will be subject to stricter supervision and control. Behaviors such as talking down, being bearish, short selling, and hollowing out the market are managed by the state security departments. The overarching management approach places the intentions of the Chinese Communist Party policy first, rather than following traditional economic laws. The capital market emphasizes the financing function, encouraging sustained investment rather than short-term cash out. For local government debt issues, policymakers choose to assist local governments in resolving debt through central bank printing and issuing bonds overnight to prevent problems in the banking sector. For the real estate market, the policy tends to stabilize the market by providing ultra-low-cost subsidized housing, satisfying public needs and preventing public unrest, while allowing private real estate companies to go bankrupt and public enterprises to expand. The current economic management strategy emphasizes stability in the financial markets under the centralized power of the Party Central Committee and Xi Jinping's leadership. It is supporting local governments and repaying debts, and stabilizing the real estate market through central policy. This indicates that China's economic management has abandoned market laws, relying on political means for management. Going forward, understanding the trends and regulatory dynamics of Chinese politics will become key to interpreting the country's economic trajectory.